Glad to know you're still with us. Building wealth goes beyond earning and investing. It also requires disciplined financial habits and responsible borrowing. As access to loans expands, individuals must understand when debt can support wealth creation and when it can undermine financial stability. On this episode, we examine smart borrowing, debt management, spending discipline, and habits that sustain long-term wealth. To unpack this, I'm joined by Ariens Shakarho, Head, Business Operations, Meristem Finance Limited. Good morning, and thank you for joining us today.
Thank you very much, Perpetual. Very glad to be here.
I'm here. Good to have you. I want us to begin, from a very broad note of all of those things. What do we mean when we talk about wealth management?
So wealth management, it goes beyond just saving and investment. It's how you make your money work for you, how you earn, how you spend, how you borrow, and how you grow your wealth. The important thing is to know your income and your outflows.
All right, that's quite interesting. Well, is loan a wealth building tool? And if it is there such a thing as maybe when an individual should start considering taking a loan and, things in that regard?
Yes, loans can be wealth building tools, but it depends on what you're using it for.
Okay.
So if you're taking a loan to add value, let's take, for example, an individual who wants to go to school, you use it as an education loan, or a company who wants to acquire assets, vehicles, to expand your fleet, to generate more revenue. Yes, a loan can be a tool.
And then when is it financially unwise?
When it's financially unwise is when you use it for consumption. So, for example, you want to take a loan to go on holiday. That's financially unwise because a loan should add value, not just to fund a lifestyle of consumption.
All right. So does that sort of help us answer the question around good loan, bad loan?
I wouldn't really say good or bad loans.
Okay.
I would say productive loans.
Okay.
And non-productive loans. And just like I said earlier, productive loans are the ones you take that takes you from one point to another. You understand the structure of the loan. You understand the fees, the tenor. You understand everything about the loan.
How will you understand all of those things? I mean, I've heard people who talk about how that they need loans, then they bring these forms with tiny, ineligible writings, and they just want to get there. And sometimes the FA, maybe financial advisor or whoever who is representing the company, is just in a hurry to get you to sign. Sometimes it's at the end of the day, they then realize that they signed some clauses they were never aware of. How do you even, deal with that?
So the first thing is to understand why you're taking a loan. Do you really need the loan? You first have to understand, okay, I'm taking a loan, but what's the purpose? Understand why you're taking a loan first. And then also consider, can I repay this loan? It's not just about taking the loan. You have to take a loan that you can pay back within your income. So take, for example, someone, an individual, a salaried person who earns 500,000 a month, and you say you want to take a loan. You're not sure what you're taking the loan for. Maybe there's an ashrebi, there's a party you want to fund. And then paying back that loan will require you paying maybe up to 250K a month. Now, the
question, yes. 500,000 naira salary.
Oh, you'll be surprised at what people spend to boogie.
Okay.
So the first question is, do I really need this loan? If I do need, if I've considered that I need the loan, can I fund it? Can I repay this loan? How much of it is going to eat into my personal expense? And then understanding, okay, even if you qualify for the loan, because there are lenders that will reach out to people to say, come and take a loan.
Even banks. Sometimes I open my bank app and they're telling me, oh,
you qualify for this.
I mean, a lot.
Exactly. But the fact that you qualify for a loan is not automatic access to you taking a loan. You must ask yourself, why am I taking this loan?
All right. There was something you mentioned that made me, talk about a lot of things about sometimes people are not aware of the contract they are signing while getting a loan.
Yes.
How do we deal with that?
So first of all, understand from your lender, your proposed lender, understand the terms of the loan. When you're taking a loan, there are fees you will pay. There is the interest fee element. You must understand, you must ask questions. In some cases, you could ask the lender to give you a repayment schedule. So for example, you say, okay, I want to take a loan of 500K, but how am I going to pay this? Over what tenor? okay, I can spread it over a year, I can spread it over 2 years. All of that conversation must be had before you take a loan. Just jumping and taking a loan without understanding what you're signing, is not a wise financial decision.
Interesting. So what are the warning signs that a person is becoming over-leveraged? That's the person is already too heavy, too neck deep in debt.
First, if majority of your income goes into paying back your loans. The example I gave earlier, you're earning 500,000 and you're servicing loan with half of your income.
What if it's
How
not
does
just
that
one,
leave you?
What if it's not just one particular loan, maybe multiple loans?
I was going there. Okay. So one of them is when your income is overly stretched by a loan. And then when you have multiple loans, there are some people who take loans from 5 loan apps. So when you have multiple loans, not just one, and then when you're borrowing from Peter to pay Paul, I'm sorry for using that analogy, but when you're borrowing from lender A to pay lender B, that already shows that you're leveraged, because what you're doing is that you're now beginning to fund your lifestyle with borrowing. Borrowing should not be for you to close gaps, take from here and put here. So that's how you know you're over leveraged. And also, when a borrower begins to miss payment, when you begin to default on repayment, that's another sign.
I'm sorry, I just
Let's not go there.
That's even corporate. Yes. We're talking about individuals anyway.
Yes. So yes, for corporates too, it happens. Sometimes they're not able to service their loans because they're just over leveraged. They've borrowed from too many financial institutions, banks, and they're not able to meet up.
All right. I would like us to get to the point where we probably talk about what to do when you are already at that point where you are over leveraged. I mean, and all of those things, because I don't want us to miss some things. Talk to us about financial habits that would help someone really.
Okay, so financial habits. So let me switch over to companies now. If you want to come out of it, the first thing to do, stop borrowing whenever possible. Just have an idea of what you have already borrowed. So if you're owing different lenders, engage your lenders and say, okay, can I have a balance statement? I want to know what I'm owing you. Do that across all the lenders that you're owing. They will give you the figure of what you're owing as at the day you've asked for it. Engage them. If you're having problems, it could be restructuring the loans. If you're having problems repaying, you could ask them to either extend the loan tenor for you, restructure the loan so that the repayment amount is smaller. So those are ways you can get out of it. For businesses, sometimes it's the same thing. Engage your lenders and just find a way to restructure those loans, extend those loans, and then try to keep up with your repayment, because non-payment actually affects people's credit history. That's something that a lot of people and businesses don't, especially for a business. Never let your loan to extend so far that your lenders are chasing you, because that gives you a bad report. And the next time you want to go to another institution for a loan, your credit rating is bad. So always ensure that your credit rating is good.
Back to the first thing you said, or what you said when I asked you the second question, getting a loan for a car or mortgage, those are good or bad loans?
It depends.
Can mortgage ever be bad?
Mortgage cannot ever be bad, but can you repay?
Okay.
Everybody would love to have a mortgage. So it's not, I want it. You have to decide, can I afford it? Can you pay a mortgage? So someone says, okay, a bank will say, I will structure a mortgage for you. The house is 100 million and you have to pay back, let's say the mortgage is structured for 5-10 years, but you have to pay a certain amount. Can you afford it?
With your salary.
With your salary or with your business and your income. So it's not just what the loan, because a loan can be good for A and not good for B, because your circumstances are different. So the key thing is the purpose, your ability to repay, the affordability to you. So all of that is important.
So is car an asset or liability?
Again, it depends.
I remember growing up. That's okay.
Sorry. For businesses, vehicles are usually, they're called assets because they are used to generate income. So when you're buying, let's say a company that buys a truck, It is an asset because it will generate income.
Personal finance, we're talking about individuals.
Personal finance, yes, a car could be an asset. A car could be an asset, but you will always have to remember if you can afford to service a car. But when you can, if you're on a salary, and let's say you're on the salary of 1 million and your repayments are no more than 150,000 per month, yes, go ahead. But you must be able to repay.
Let's talk about lifestyle inflation. I mean, it's a common challenge as income increases. How do we deal with that?
Just make sure that your savings and investment always overshadows your expenses. So, as we know, inflation is always on the up, whether in Nigeria, developing countries, or developed countries. So you must always ensure that if your income is rising, your savings and investment will also rise as well. That's the only way you can beat inflation. So there are different investments out there. There's mutual funds, treasury bills, fixed deposits, and all of that. When your income starts to increase, do not begin to increase your lifestyle as well.
Maybe move to the island.
Exactly. You know,
move
some
to
people,
an estate.
you know, the one of the Joneses.
Upgrade your car.
Upgrade your car. So you doing all of that is fine. However, you must deliberately ensure that your savings and your investments are growing faster than you're upgrading your lifestyle. Okay. That's the only way you can build wealth. Some people want to wait till they have hundreds of millions, tens of millions before saving and investing. No, start small and scale up.
Interesting. So let's close this. If you could recommend 3 financial habits, for young people who are ready to build wealth, what would that be?
First, have a budget and live below your income. I cannot emphasize that enough. I've spoken to a lot of young people on this. If you're earning 100K, live like someone who's earning 40 or 50K, so that you can have a little bit set aside to grow. So you must have a budget and you must live below your income. Some people are on an income of 150,000, but they will look and dress and act like people who are earning millions. Already, you know that is a disaster waiting to happen. Secondly, you must save and invest. The reason you're living below your income is to save. I know in Africa, we have this thing called black tax, where you have to support your family, your friends. You cannot solve the problem of everybody. So you must pay yourself first. Paying yourself first means when your income comes, allocate a certain percentage and save it. And then you can now begin to do the rest with the others. So live on a budget below your income, save and invest, and then borrow responsibly. Do not just go and borrow just because you qualify. Your bank has been writing you to say, oh, you can take so and so loan. No.
I have a lot of it on my Then when I open, I see everything. I'm like,
yes,
okay.
It can be tempting, but the thing is, it's not free money. Some people look at loans like free money. It's not a grant. A grant from a government or an institution, there's usually no, most times there are usually no fees or payback clauses. A loan is not like that. A loan is an obligation, and you must commit to repaying that obligation. So when you even receive your salary, your payment, your revenue, one of the first things that you should do is apportion the amount goes towards repaying your loans.
Absolutely, that's quite interesting. I think it's also important that we check the interest rates before going, because that could be 2 banks and they offer different interest rates, so you have to go for the cheaper one, really.
And understand all the terms and conditions.
All the terms.
The interest rate for A could be smaller, but what about the fees? There's all kinds of fees, processing fees, admin fees.
Oh, wow.
Read between the lines. Oh, is there a charge after? If I want to liquidate early, are there penalties? So all of that should be clearly spelled out in the offer letter that you will sign. And please do not be rushed into taking or signing a loan agreement. If you do not understand the terms of the loan, how it affects you, how it affects your payment in the future, please do not be in a hurry to sign.
Some of these things are even done digitally. Nobody's bringing you paper to sign.
So read them. Read them, because you're committing yourself to sometimes as long as 2-3 years. So why will you not take, even if it's 30 minutes, to read the fine print and understand exactly what you're going to? Because a loan is like a relationship. Once you've entered, you've entered. And once you've signed, you've committed yourself. So.
Thank you so much. I had a great time listening to you. Thank you.
It's been a pleasure.
I hope to have you some other time.